changes that are coming up and potentially how to avoid it. So land tax is one of those, I guess, invisible taxes that you kind of only realize that happens once you've got to 1, 2, and a couple of properties, and you'll suddenly get an assessment in the mail and find out that you owe a bunch of money. So in this video, we've got Emily Pritchard, who's from ACIS, who's a bit of a land tax expert. Obviously, everything we're going to cover in this video is general advice only. There's nothing specific. So if you are looking for specific advice around land tax, around structuring, Emily's and ACIS is the right place to go. So we might start, I guess, at the very beginning, Emily, with what is land tax and how it can derail investors potentially.
Yeah, exactly. It's a really good place to start. I mean, it is a state-based tax, really, what land tax is, and it's an assessment for that state-based tax based on the land that a person or an entity owns on a particular date.
Yeah, and I guess it's based on the amount of the size of land as well. So if you've got an apartment or a unit, it's obviously on a smaller, physical lot of land than if it's a property. But there's some changes where I guess previously this was pretty much a state-based tax. So hypothetically, you could have one property in Queensland, one in New South Wales, and it was state by state. But there's some huge changes that are coming out in Queensland that may even affect other states and will affect investors here. So can you give us more details around that?
Yeah, absolutely. And I think you're right. These are huge. I think it's important to get the awareness out there before these changes come in so that people can, where possible, do something about it. But, up until now, and in fact, up until mid-June next year, the current land tax regime in Queensland assesses a person or an entity. If they don't have the land, in their personal name, they might have it in the name of a company or a trust. So the current regime assesses them based on the property they hold in Queensland. So that makes pretty much, makes sense. What's changed in the current regime and will have effect from the next land taxing date in Queensland, which is June 30 next year, is essentially that when the Queensland Revenue Office is assessing a person or entity for their land tax liability, they're actually going to start looking at all of the land they own across the nation. So instead of just saying this person owns these 2 pieces of land in Queensland and assessing them in Queensland based on that, they're going to look at the total value of the land that entity holds across the nation, and they're going to use that total value to determine whether that entity gets access to thresholds in Queensland and what rate of tax that entity pays. So it's a really big change. They then, I guess, apportion the Queensland amount in, but it essentially really results in a higher land tax bill for entities holding land in Queensland and other states.
Yeah, it's wild. So I remember over the years, I've had clients that try and, dispose of properties before that sort of June 30 deadline because they're going to have the land tax. So I guess sort of the next question is how is it determined, I guess, broadly speaking, but how do they kind of calculate land tax, at the moment?
Yeah, and I think that's a really good point to ask because it actually raises some of the inequities in this change. For example, the rates of land tax are different in every state. The land taxing dates vary from jurisdiction to jurisdiction. So in Queensland, the land taxing date's June 30. In New South Wales, it's December 31. Under this new regime, if we assess a Queensland landholder based on property they hold on June 30 in, say, Queensland and New South Wales, they may have disposed of that property by December 31 when the land taxing date rolls around in New South Wales. So that doesn't make much sense to me. Equally, I think the access to thresholds and the rates of tax varies from state to state. So if a discretionary trust holds property in Queensland, it can enjoy a land tax-free threshold of up to $350,000. There's no equivalent in New South Wales. So a discretionary trust holding property in New South Wales doesn't enjoy a land tax-free threshold at all. So it's odd to me that we're going to combine these values across different jurisdictions for the purposes of calculating Queensland land tax when we still have these differences between jurisdictions and how land tax is imposed.
It's wild. And I guess it'll probably come to another point, which we're going to get to, I think, in ways to mitigate entities and different ways to think about it, because it's so common for people to just go, I'm going to buy investment property. I'm going to put my name because it makes sense, I guess. That's what my current home's owned in, without sort of thinking this ahead. And I guess you've got a couple of examples where under the current scheme, what it's going to look like and some of the changes under the new system and why this structuring stuff is super important. So do you mind sort of taking us through what those examples look like?
Absolutely. So I've gone with a simple example where a person owns property in Queensland and in Victoria. I've said that the Queensland property is $745,000. The Victorian property is $1.565 million. So what would happen under the current system, this year's land tax in Queensland, is that Victorian property of $1.5 million wouldn't even be considered. all that would be looked at would be that $745,000 property in Queensland. And based on that land holding in Queensland, an assessment of about $1,950 would be generated. Fast forward to this time next year with exactly the same scenario. So Queensland-based property, 745,000, 1.5 million odd in Victoria. When it comes to calculating that entity's land tax liability in Queensland, we're obviously going to start looking at both. So it's their nationwide land holdings, and they're going to have a total of, what does that get us to? 2.3 million. So we're actually then, the assessment of land tax will happen on 2.3 million. So all of a sudden that land tax bill has become about $26,000. And that amount will then be apportioned back to the Queensland land holding. So it results in about an $8,500 land tax bill. So current regime, we're talking $2,000. Next year's regime, we're talking $8,000. So it's a $6,000 increase with no change in circumstance, no change in value of the properties, no acquisitions, no disposals.
That's wild. And I guess the other thing that, land tax, it's a double-edged sword because you want your property to go up, but as property values increase, and as they have over the last few years, those costs are going to increase. And it can get pretty expensive. Like if you're out of pocket every year, 8,000, landlords potentially will pass that on to tenants. If there's people living in there, they're going to need that money to come from somewhere or sell for this. So I guess it's a kind of thing that you have to get correct up front, because even changing the ownership of property after you own it, you're paying stamp duty and things again. So like, what are some ways, well, I guess firstly, what does it mean for investors out there? And what are some ways to kind of mitigate that?
Yeah, I think what it means for investors is a really tricky one, because to an extent you feel for them, they potentially bought, say, this Queensland and this Victorian property, budgeting on what the current regimes were. They're now changing. And like you said, they've got to come up with an extra $6,000 from somewhere every year for their land tax bill in Queensland. Even worse still is if other states jump on this bandwagon and implement a similar thing, they potentially have an equivalent problem in Victoria, or even more in Victoria, because that's where the larger portion of the land is held. So I think that's something that people need to really start thinking about, obviously, ideally, before they make these acquisitions. But that's not always going to be the case for those who already have the properties. That's a consideration for them, what they can then do. And I know we'll talk about that as well today. But I think the really practical thing that this means for landholders is the obligations on them to tell the Queensland Revenue Office that they actually have property in other states or territories. So if you hold land in Queensland, basically you have to have let the Revenue Office in Queensland know if you've also got land in other states by it's a sliding scale depending on the circumstance, but it's essentially September, October next year. So that's on you. Likewise, that's on you if you receive a land tax bill in another state, for example, and the value of that property has gone up, you then need to advise Queensland Revenue's Office that the value of your interstate property has gone up. So that's an obligation that's on the landholder.
Wow. And it's one of those funny things, because this was always, I guess, diversification and buying in other states was always the way to kind of sidestep land tax. Because, a lot of investors say, well, I've kind of, even clients of mine, they hit that threshold in Queensland, so they go to New South Wales and then on and so forth. But with this new system, it's kind of it's nullifying that, possibility. And like you said, worse still is if you're getting hit by every other state, potentially if it does change.
Exactly. I think the phrase that was used by the Queensland government when it was first introduced in the budget was closing a loophole. So you can bet your bottom dollar if the other states think they can close a loophole and raise some revenue at the same time, they'll be there to give it a go. So I think, that's something that people really need to be aware of. And my concern also is that some people will not be aware and until really the first bill turns up. Then they really see what it means for them.
Yeah, which is often the case. So I guess ways to mitigate it, probably starting from assuming you haven't bought a property yet and you're sort of looking at getting advice. Like I said, the default might be you and your partner might own a property, therefore you and your partner buy the investment property together. Structurally, that sounds like that's an issue. Like, I guess, what are some ways to mitigate future land tax and that sort of $8,000 burden that you could end up with?
I don't think there's ever been a better argument for separate structures for each purchase going forward. I think that's long been a consideration. Obviously, from an asset protection point of view, we say separate structures is a good thing. But I think based on this new regime that's coming in Queensland, separate structures, which essentially means separate landholders, has got to be a really prominent consideration before, like you said, if you've got the benefit of being able to consider this before the purchase is made. The other thing I'd say is where discretionary trusts are the chosen structure. And we're talking about putting, separate properties in different jurisdictions in separate trusts. I'd also be, putting a lot of consideration into making sure there's probably separate trustees for each trust. And I appreciate sometimes, purchasers don't want the additional expense of having, another company and another trust. But there are land tax aggregation rules that exist in Queensland in relation to trusts that have the same trustee and the same beneficiaries. So what I wouldn't want people to kind of fall foul of here, I guess, is having separate trusts for the purposes of these new land tax aggregation rules. So we've ticked the separate entity, I guess, criteria, but then put the same trustees in and potentially fall foul of other land tax aggregation rules in Queensland.
Wow. Yeah, that's interesting because it's kind of, you're trying to do the right thing, but you get caught out because you tried to cheap out and not get a new trustee.
Yeah.
or
I completely understand. You want to do it the most efficient way. If you've got big land tax bills coming in, you want to save money wherever you can. So I completely appreciate that. But yeah, this is certainly an argument for separate structures.
Wow. Yeah. So that's, I guess, a fair point. In different names, if it's different entities, from what I understand in general, like if it's, it's based on sort of individuals as well. It can be sort of trusts or, companies potentially, depending on your structure, it's considered a different entity and you can control it. So getting advice around that's obviously important. If you already own a property, like, is there much you can do at that point to kind of mitigate any of this?
Yeah, there certainly is. It is obviously a little bit more complex than what we've just discussed, and that's where you've got the benefit before you make the purchase. That's when you're going to start to need to consider restructuring for this purpose. Obviously, there are some bigger considerations to take into account there. So you don't want to have to pay duty or CGT for the purposes of this restructure. But where there might be available restructuring options there, they should be considered, in response to, I guess, this land tax aggregation issue. But that's certainly something I'd recommend people go and get some advice on.
Even from the lending perspective, I guess, as well, with the banks in general, your borrowing capacity can be reduced if you buy it in a company because there's not negative gearing and there's different sort of treatment there. So I guess there's a couple of different things you really need to consider before doing this. And even, like I said, the sort of default position, a lot of times people go to auction, make an offer, you put your name on there, you don't even think about it. Then a lot of times we'll sort of say to people, you probably need to talk to your accountant about putting an entity together because it can take, and even like, it takes a bit of time to make sure you got the right structure and get things set up.
That's right. Yeah, we're very proud at ACIS that we turned around new structures pretty quickly, but you're absolutely right. The thought process that goes prior to that and getting the advice around what structure actually needs to be ordered can take some time, and it's always a good idea to get the advice around that. Yeah. No, that's pretty huge. So some really big changes there. I think that's probably most what I had for today. Emily, do you have anything else you'd like to add? No, I thank you for kind of shining the light on this. I think it's really important for investors to have this information so that they can make those decisions where possible prior to making the acquisitions. Yeah. And I think, like I said earlier, this is obviously all general advice. So, you need to get personal advice. Emily and her team will be able to definitely help out with that. We'll include some links below. They've helped me in the past with trustees and different things. So if you're looking at that, it's definitely the right place to go. And they're pretty quick, which is important, especially if you're trying to get things done. And pretty quick with our structures, and certainly happy to connect you with the right people when you want that written specific advice. Absolutely. Awesome. Thanks for your time. Pleasure. Thank you.